Now, let's see how the proprietary trading firms control the risks of high-speed trading. See, exchanges can control the risk of high-speed trading, and at the same time, the proprietary trading firms themselves can control the risk of high-speed, because at the end, the objective is make sure that high-speed trading is giving the desired benefit, but at the same time mitigating the various risks that are arising in the process, because everything is driven through algorithms, because everything is driven through proprietary codings that are getting developed. It has to be ensured that the risks in the system are much decreased. So we are going to talk about the pre and the post trade risk controls associated with this high frequency trading. Just a quick introduction to the world of high frequency trading. It is automated through various software programs, completely algorithmic trading driven. Thousands of orders are sent to the exchange within seconds. So highly powerful networks and servers play a key role in this process. And generally, this is being executed by the firms which access the market directly. In general, every firm which wants to place a trade, it places the trade with the exchange via a broker dealer, intermediary, or probably a future commission merchant in case of futures, broker dealer in case of stock market or options market. So, in some cases, they may bypass this route altogether and they may place a trade directly with the exchange. In the exchange, the matching engine is the one that takes care of matching the buy orders with the sell orders. So, this firm will typically use its high powerful technology softwares, either proprietary or purchased from some vendor. They use that particular trading platform to place the trade directly with the matching engine of the exchange. And in this case, especially this particular phenomenon is called as sponsored access in case of equity markets, and it is called as direct access in case of futures market. And this is something which is contributing to a heavy volume in the markets, which we could clearly see contributing to 25 to 50% of the total trading volume that is happening at the exchange. However, there is no clear definition of what is meant by high frequency or high speed trading. Typically, the exchanges are looking at from that perspective of wherever there is a direct trade that is getting placed through the matching engine of the exchange, that is being considered as a high frequency trade. Bypassing the broker dealers and FCMs is typically getting considered as a high frequency trading. And we have seen earlier also that on one side they can provide more and more liquidity, but at the same time they have no obligation to provide liquidity, which means some high speed trading firms which are acting as dedicated market makers, they are regulated. They quote the two sides of the market over a specific number of days for every asset class. Whereas the ones which are not designated as market makers, they don't have any obligation to provide the dedicated liquidity. So what will they do? For them, try making the best out of the price mispricings. So invest in faster and better technology. Try to identify every small profitable opportunity, take advantage of those opportunities. And in general, also, especially with the options market, where we see heavy number of stocks, each stock option have each stock having multiple combinations of the strike prices, and again for each strike price multiple contract months. So which means for one single stock the number of combinations that are available for the trading purpose are very high in number, which means maintaining the liquidity at every level is very difficult. So that's one thing that has to be looked at in the future, whether this high speed trading can provide that much of desired liquidity for each of the product class, for each of the strike price, for each of the contract month in the options market as well. And coming to the market makers, in the stock and options market, we see heavy usage of market makers, and the high speed trading firms are trying to eat up the profits associated with the market makers. In case of futures market, we don't see designated market makers, so which means the high speed trading firms at any cost have no obligation to quote both the buy side as well as the sell side. So their objective goes more and more in terms of making the best of the mispricings that are coming up. But all these things, they typically introduce wide variety of risks which really need to be handled to the core. Okay, now what kind of firms typically are getting into this high speed trading process? So here majorly we see proprietary trading firms itself, not public listed kind of firms. Proprietary firms, they hardly have any customers, they don't have customers, they are doing the trading on their own capital. So those are the firms which are heavily using this mechanism of high frequency trading or high speed trading, typically called as. They are getting into the designing of their own algorithms, getting into their own proprietary softwares or vendor purchase softwares to execute the trade directly with the exchange. So these are the firms that trade on the exchanges, electronic networks, and some in the dark pools, something for which they are not needed to disclose anything. And some of them may be present even on the trading floor of the exchange. So which means they are literally trading almost on everything. And again, as an interesting profile, some of these firms, they get into self clearances. They are the clearing members as well. They get into the clearing of most of the trades, and for some of the trades they take the support from the clearing members for some of the products. Whereas some of these firms, they for most of the trades they depend on clearing members itself, but instead of one, they may depend on more than one clearing member to clear all their trades. And typically the kind of product profiles they get into, almost every asset class they get into: equities, futures, options, foreign exchange, fixed income, over the counters in multiple geographies, which mean wherever the system or the algorithm is able to identify the mispricing, they are going and placing the trades there. So they are primarily accessing the markets directly, either with their own trading platforms and software, or they are trying to procure them from some reliable vendors. And in that, whatever the trading strategies we talk of, they are classified primarily into two broad classification. One kind of trading we call as black box trading, the other is called as a gray box trading. Strategies which are 100% automated, pre-programmed, and the traders cannot interact or modify the algorithm, that is called black box trading. Once designed by the team, tested, approved, implemented, no one can really change the algorithm. That is called as a black box trading. Whereas in gray box also, we talk about 100% automation, pre-programmed, but at the same time, the trader is able to modify the configuration for the algorithm based on the situation, which means it is left slightly to the discretion of the trader. So, the firms can typically either develop this kind of algorithms on their own, but even if they develop it on their own, it is observed that majority of these companies, they even purchase the external vendor developed trading platforms and software just as a backup in case their proprietary developed software and a platform is having some kind of errors, because of which they are not able to place the trade for that particular period of time. This particular vendor purchase solution is being used as a backup, contingency scenarios, and in case they want to really exit out of the positions. All these things, are some of the important aspects that are associated with the companies which are getting into this high speed trading profiles. Coming to the strategy part, though every trading firm has its own specified kind of a strategy, on a general basis what we see is the trading groups, all the traders and a group of traders, they work with the IT staff, programming, coding, testing. They typically translate whatever the strategies they have designed into the source code. And every new strategy that is designed, it has to go through the phase of requirements analysis, design, coding or development, testing, implementation. This entire software development life cycle, the IT based software development life cycle, in some for some kind of strategies it could be done in minutes by just tweaking some kind of programs and quickly running it. Whereas if the strategy is a completely innovative one, it can take a few months and even up to 1 year as well. So in some companies, this entire process in those high speed trading firms, this entire process has been made proprietary. Means there is an in-house development team which is understanding the requirements of the traders, conceptualizing it and generating the software of choice. The formalized development process is there in every organization. The team consists of people from trading, risk management, IT, and all departments. So if I look at a step-by-step process in which this is developed, every new trading strategy that is developed, there is a back testing that is being done. A simulated trading environment is being performed, and it is clearly seen in a typical backtesting process. We try to apply this on the past data, see in how many occurrences or cases there is a discrepancy, see how many discrepancies have significantly come out when you are trying to compare it with the past data itself. So you are analyzing the results. And when you are clearly seeing that this particular strategy that you have implemented is not economically viable, modify the strategy or terminate it. But in case it becomes viable, now set a few risk limits, move it from the test environment to the production environment, but start trading in small quantities. And after that, see the results with respect to the small quantities. Even at this stage, if it becomes economically not viable, look at modifying the strategy or exiting even at this stage. But if it is found to be more viable, set the risk limits in the strategy and go for some kind of hard coding in the source code. And once you are fully confirmed that this strategy is a viable strategy, finalize it, take it into the production environment, and then to the large quantities. That's a typical step-by-step process for any new trading strategy that is going to be implemented. And some companies do have even a compliance team, which clearly questions the traders on how really they find this particular strategy in terms of generation of the profits, what is the kind of risks that are associated with the strategy, to what extent they are able to understand the markets while they are introducing this new strategy. These entire things are being taken care of by the compliance team. Now, the next dimension is, okay, the entire software is being either inbuilt or purchased, whatever is the mechanism. What are the typical access controls? Who are going to operate it? Who are going to edit it or change the various features associated with that particular software? What we typically see is, depending, though it differs from firm to firm, overall we see the traders, programmers, the IT group, quality assurance group, they all are involved in terms of developing, editing, accessing the source code. But once it is placed in the production environment and run, only the traders or the trading group only is allowed to modify certain parameters. And for that, a graphical user interface is designed using this GUI. The trading community can only modify the parameters. No other, the IT teams or the quality assurance teams, they cannot directly get into this. And at the same time, there is a log that is maintained. Who has accessed it at what point in time? Who has made changes to the source code at what point in time? And they are reviewed on a periodic basis. And when a big problem is detected, this review is really very helpful. Coming to the risk management aspects, the first thing we really need to appreciate is different firms have different structures with respect to risk. In some cases, there is a hierarchical structure, which means all the trading as well as the risk staff, they are reporting directly to the risk managers. The different departments, they are reporting to the risk manager, single risk manager, and all the trading and the risk staff are reporting. This is a hierarchical structure. Whereas in some cases there could be a horizontal reporting structure. So every trading desk has a separate risk manager. So equities trading desk, a separate risk manager. Bonds trading desk, a separate risk manager. Options trading desk, a separate risk manager. But there is no enterprise level risk manager. So that is one structure. And in some cases, it could even go to the extent of central location based, if even though there are multiple offices that are there for that trading firm. So depending on the structure, we need to understand the entire risk management process. Coming to the platform, the differences are some companies build their own platforms, whereas some of them buy the platforms from the vendors. But at the end, all of them are targeting the same. Check all the trades. because the risks are very much possible in each of these mechanisms. The intention is to make sure that the risks are mitigated to a large extent, the exposure is controlled to a large extent. And what we see is majority of these trading platforms, they operate in the near real time, at least for the electronic trades. But for the open authorized, data has to be entered into them. So what we see is generally that happens at the end of the day. And if you look at any of these, whether inbuilt or externally purchased, the inputs for each of these models, that comes from either the internal data which has been compiled by the firm in terms of various trades that are executed. It could have been purchased from an external vendor, or some kind of a data is very much provided by the trading venues like exchanges, while some of them can be purchased from these exchanges. So the data can come from any of these sources. And typically, because the data can come from any of these sources, in some cases the data could be corrupt. In some cases, the data could be erroneous because of whatever reasons. So it is very much necessary that this particular platform should have the capability in terms of performing cross checks to identify anomalies and outliers and do some kind of reconciliation with reconciliation of the internal records data with respect to the one that is being looked at from the exchanges or any other trading venues. And coming to the analysis or the estimation of the profit and loss statement for each of the trading desk, any of the algorithms can be used. A value at risk, span, or any other proprietary algorithm can be chosen to estimate the profit and loss and the amount of exposure that is there. And but some of the firms which do not hold positions overnight, they really don't need to compute this value at risk kind of numbers. But one thing with respect to these platforms, not all platforms are capable of calculating the enterprise wide. While they are very good at computing the individual account wise risk, but aggregating it to the enterprise level and computing the portfolio risk, looking at the diversification aspects, looking at the correlation aspects, is something that is a limitation with majority of the trading platforms. And coming to the limits, trading limits can be set at various levels. They can be set at a trading desk level. For each trader, a separate limit can be set. For each trading group, a separate limit can be set. For each product, for each trading strategy, for each exchange, there could be a separate limit that could be set, and there could be a master limit for the overall firm as well. Here, with respect to the limits, as a part of a good risk management process, the CEO or the management committee of the firm, they are reviewing the risk limits on a daily basis in an informal way. But more and more formally, there could be a series of meetings that could be held either on a monthly basis or on a quarterly basis. And at any point in time, a limit breach is occurring, the system should have, the trading platform should have the capability in terms of sending the traders audible or text or email kind of alert, or in some cases stop the trade entirely, liquidate the trades, or require the traders to take opposite positions. So which means action needs to be implemented immediately after a limit breach has typically occurred. So all these make the risk management process more and more effective and improve the confidence in this high speed trading process. So again, on that same lines, there are some pre-trade risk controls as well as the post-trade risk controls that can be implemented by the proprietary trading firms themselves. So coming to the pre-trade part, any algorithm problems that can crop up because of the corrupt data or programming errors, hardware failures, network issues, or any other unforeseen circumstances, they all need to be identified out in the initial stages itself before the trade is placed with the exchange. Typically, when we look at out of control algorithms or erroneous orders, they have to be stopped at early stages itself. And all this has to be applied at individual accounts levels. But in reality also, we have seen that majority of the firms, majority of the trading platforms do implement this kind of mechanisms or risk controls generally at the account level, but they don't do it for each trading strategy. They intentionally don't do it because they want to speed up the trades that are placed. So they are trying to compromise on the risk controls at the just to gain more business by promoting the reduced latency period. It's a kind of a risk that they are taking in the process. And typically they set lots of limits at the pre-trade level itself. It could be with respect to maximum size order. It could be intraday position limits. Sometimes it's a fixed limit, or sometimes it could be based on the percentage of the average daily volume in every asset class. Credit limits can be set for every trading account, which is restricting on the dollar value of the trades that could be placed in a particular day. And again, it could be same for all accounts, or it could be purely based on the profit and loss statement that is generated. For each product that could differ, for each open position that could be different. And there could be price bands kind of mechanism wherein orders are checked against a specific price range, and only if they are lying within that price range they are sent to the exchange for execution. Otherwise they have the facility of getting cancelled. And in case the limits are breached, there should be a mechanism where the trading gets halted. And in some cases, there could be limits with respect to the number of orders that can be sent, number of messages that can be sent to a trading venue within a specified period of time. When it comes to post-trade, after the trade is being performed, the trading venues are reporting a post-trade information. Some exchanges, they report only the executed trades, not the working orders, whereas some exchanges, they report even the working orders also. Some exchanges, they provide this information on almost a real-time basis, whereas some of them are providing this report at the end of the day. Some of them, they give more and more detailed at each account level, whereas a few of the exchanges are providing this information on a consolidated view of the trading activities rather than giving a very detailed picture of the same. But whatever is the way, the post-trade information is received by the trading desk of each of the firm. They are trying to reconcile this information because generally they store all the trades that they have placed as a part of their internal database. So they try to compare their internal database with the data that has been supplied by the exchange, and try to see the discrepancies that are existing between the two. And at the same time, they also have a few additional checks just to identify the orders that are placed too rapidly. Compared to their historical data, if they have really found that a few orders have been executed quite faster than what they have expected, the trading platform can automatically shut down or delay the trade for a few seconds and verify the trades that may have occurred. They can call up the exchange, find out the trades that have typically been placed and successfully filled before the shutdown has happened, and probably request for a cancelling of any of the trade, or mention that the trade is an erroneous trade and try to really cancel those particular trades. That kind of risk control mechanism post trade are even present with many of the proprietary trading firms. Apart from that, if they are seeing any kind of error trades or out of control algorithms, generally one mechanism the exchange does is it busts all the trades. But that happens very infrequently. And a lot of times it has been attributed that the flash crash that has occurred on May 6, 2010, it has been promoted in the news and the media that it has occurred primarily because of the out of control algorithm itself. But majority of the proprietary firms, they really feel that rather than the technology or rather than the mechanism of the out of the control trades or algorithm, it's the volatility and the financial news that has typically done more damage. The infrastructure in the equities market has devolved. Liquidity has gone completely into the dark pools, and the traders, they were not able to quantify the risk, and it resulted in everyone liquidating the positions until they can, resulting more and more damage to the system. So the stop orders which were used very heavily, they became the weapons of mass destruction. So the error trades really need to be identified and typically acted upon much before. Otherwise, they can create this kind of devastating effect on the overall financial system itself. And in some cases, it has been observed that a firm gets caught in another firm's out of control algorithm. So, I mean, the algorithm which has been successful for one firm need not be successful for the other, because once you are implementing the same, it looks as if the orders that are placed for the first, but for the second firm, it could be a delayed order for a modified price. So, enhanced credit checks need to be performed at the pre-trade risk control level itself. And in some cases, if the logging of the confirmed trades is not happening, it can result in more and more orders being placed, which could result in a more erroneous thing, because you are placing the same trade again and again, which is resulting in more number of trades being placed, more number of orders being placed if within a few seconds of time, which results in the overall system getting crashed as well. And in some cases, there could be a problem with the pricing algorithms. In some cases, the limits that are hard coded instead of formula driven kind of stuff could result in the error trades being placed, which need to be identified upfront itself before the trades get executed on the exchange. And there are few other controls that are available with the proprietary trading firms. They can use the mechanism of kill button, which is used in exigent circumstances where they can stop the trading at different levels, either at a product level or at an asset class level, or they could do it at a trading account level as well. And they can do it for different types of orders, for market orders, good till cancelled orders. They can do it for different kinds of orders. And this mechanism is providing an authorization only to a specific group, the trading community or the trading group or a set of traders, CEOs. Only a few of them could typically have access to this specific group. And though in many of the cases it's a manual stuff, but Even some of the trading algorithms have tried to capture the pre-programming aspect wherein this mechanism will get activated in certain circumstances. But overall, this is one kind of a risk control mechanism that is available to the proprietary high-speed trading firms to typically control the risk. And they are also provided with cancel on disconnect, where if there are any kind of network related problems that have come up, they can cancel the open orders that are there in the order book. So typically there are two major kind of connection problems, either between client and server of the trading firm or between the exchange server and the trading firm server. So each trading firm, it is subscribing with the exchange to cancel to cancel on disconnect the functionality at the trading venues that offer this service. And the timing limit, in some cases the error trades need to be reported within 8 minutes, whereas in some cases it can go even up to 30 minutes. The trading venues, which are the exchanges, they should report which orders are left working in the market and which orders were filled. That is what they try to give as a part of their drop trade report. So when it comes to the monitoring of the risk, there are a few challenges which the high-speed trading firms typically foresee for OTC trades. Obtaining the data is a very huge problem because majority of the OTC trades are between the two parties, negotiated agreements, so and no disclosures specifically required. So because of this, obtaining the data relating to the OTC transactions is extremely difficult, and probably the kind of flash crash that has occurred, creating a model to replicate those kind of scenarios, stress test scenarios for such kind of extreme movements in the market is very difficult to really come out with testing scenarios for the same. Automating of the risk checks should happen on almost a real-time basis. Sub-second basis is very much required. The drop copies, the exchanges has to provide the drop copies to all the clearing members as well as the trading firms in almost near time, not at the end of the day kind, so that they can act quite quickly, so that they can consolidate and reconcile their trades quite effectively on time. Instead of trying to prescribe vendor solutions, because majority of the time the exchange gets into prescribing vendor solutions for managing the risk, it should try promoting the individual trading firms itself building sophisticated, robust risk models and relying on the existing industry best practice documents only for risk management, because it is really felt that the trading firms typically have more knowledge on risk management than the regulators, because of they being operating in this market for quite a significant period of time. So when it comes to the best practices, majority of the firms have really felt in this world of high speed trading, algorithmic trading kind of a world, operations risk right from process related, people related, systems related is very drastically possible. So that's the reason they stress very heavily on delineating a lot of departments like risk management staff. None of the risk management staff should get into the trading activity. Probably this has been a lesson coming from the bearings collapse, and for effective risk management, it is very much a necessity that the risk management staff should not be involved in trading. Trading staff should not have any kind of access to the risk controls. Head of each trading desk must review the limits on a regular basis daily. The accounting staff should not access anything to do with the trading or risk management. The treasury staff should not have any kind of access to accounting, but on an overall scale, the CEO should get the report from each department on a daily basis. More than this, a very important aspect is the head of trading. He or she should sign a contract clearly stating that he or she is responsible for the trades that are executed by the trading desk, and in case any violation of the limits are occurring, he or she will be held personally, financially, in terms of any kind of action taken against him on a personal or a financial note. He or she is responsible for the same. Very interesting thing that comes out as an effective best practice. And what we see is the risk has been changing quite constantly. It's not a constant risk, it's a constantly changing risk, which means a regular updation of the technology, regular updation of the processes, and the tools and techniques need to happen, which means effective risk management can come out only through periodic meetings with the cross-functional teams. And it's also mentioned that as one of the good practices, the firm should reconcile their trading activity reports by getting the data from majorly three sources: from the trading venues, which are the exchanges. They should get the data from clearing members as well as their internal databases. It's a clear matching of the three, identifying the discrepancies, which can really help them act upon in a very timely manner. And from the clearing members perspective, one important recommendation which they are not following religiously at this moment is they should periodically audit the risk controls of their proprietary trading firms who are accessing the market, not just those firms which have newly got into the trading process, or which have become new accounts. Not just looking at those, but overall across all the various proprietary trading firms, this kind of mechanism should be in place. And just looking at the view of the proprietary trading firms in terms of what could be the future of high-speed trading in the next few years, they are of the opinion that the regulations being more and more stringent, they could bring the decline in the high-speed trading industry, and lots of firms will either have to exit the business, or probably consolidate with the others, which means overall there would be a few dominant firms and a few exchange groups. And every firm now has to go for investing in better and newer technology, means there's a lot of barrier to entry, and that makes it difficult for the startup firms to really come into the space and compete. And some are bringing out a very interesting point. Rather than focusing on the technology related aspect, networking related aspect with respect to the speed, this is very majorly dependent on the ideas as well as the financial engineering aspect. The kind of development that come up in the world of financial engineering will create the market for high speed trading in the future. And regarding the saturation point for the marginal returns in the high speed trading, some proprietary trading firms really felt that this market is not yet saturated. Correlations can be made for any number of products. But there is a very common opinion which brought out that barriers to entry are very high, which is making the marginal returns much thinner compared to what it was 10 years ago. And coming to key challenges that are existing for the proprietary trading firms, the off-exchange trading is eroding the public markets, the OTC-based trading. So some kind of regulations and in terms of transparency has to come out with respect to the OTC trading activities. Otherwise, it is eroding the public markets. So some kind of regulations where the transparency of the same improves need to be taken up. The drop copies that are being provided by different exchanges, there should be a standardized format for them. They should provide the data in more and more granular information, not a simple aggregation of the same. And it should be made sure that most of the exchanges are providing this information on a real-time basis so that the reconciliation and the action taking happens in a timely manner. And it has to be really ensured that every firm that is accessing the market directly is having adequate risk controls, because today that is not present with majority of the firms, and in some cases even if the controls are present, they are bypassing the control so that they are able to reduce the latency and the delays. And the drying up of liquidity even in a temporary basis is a very big problem. So the regulators have to really ensure that the liquidity does not dry up in the overall market. And market and stop orders should be banned. This is something the proprietary trading firms typically envisage. The transaction taxes, yeah, this is something that is creating a negative feedback loop, because when someone is selling because of the liquidity issue, more and more sell off happening. Even for the selling that is happening, there is a transaction tax which is making the price even more worse. So overall liquidity is getting very badly affected because of the transaction taxes. So that's some care that the regulator should work on. Exchanges should really be prevented from busting trades on their own completely. And generally the high frequency trading, it has created lot of negative publicity to itself in terms of media and the news, that it is something that is very heavily responsible for the flash crash of 2010. Whereas a lot of real proprietary trading firms and a lot of exchanges really believe that there are many other factors that have contributed to the crash, not this one. And there's one more important or most important challenge. It's like this. Majority of the staff who were working with the exchange, they know almost the order flows of every high frequency trading firm. Now, what is typically happening is this staff is quitting the exchange and joining a proprietary trading firm. By joining here, they have a very clear understanding of the various algorithms that are running. And because of that, the shelf life of the algorithms is typically going down, because the other firms are finding it as a threat, because now this particular staff has quit the exchange and joined a proprietary trading firm, and this particular person has a clear understanding on the strategy and the algorithm of the other firm. So they have to change their algorithms quite frequently, which is also being perceived as another major risk in the process. So though the proprietary trading or high frequency trading is creating a new environment or altogether, or revolutionizing the overall way in which the trading is being done, all these challenges need to be addressed in a timely manner for this to take new dimensions in the future time periods. Now, seeing in terms of how can this proprietary firms make the markets better. So proprietary firms really feel that there should be normalization in the time where the exchanges are delivering the drop copies to the clearing members and the clearing members are responding to their sponsored access clients. So the time should be normalized. Trading venues, they should apply the pre-trade risk controls and checks and limits for all market participants uniformly. Limits should be set by every exchange. Most common limits with respect to maximum position, per order quantity limit, number of messages limit, credit limit, price banding. There should be a clear-cut procedure by almost all the exchanges with respect to all these limits. This is a very interesting statement that came out. All the trading, including the OTC based, it should occur on the public exchanges itself. And today we are seeing that this is typically happening, right? And we are seeing that economically equivalent products should be fungible and they need to be cleared centrally. So we are having a mechanism of centralized counterparties or SEFs, which are typically playing a big role in terms of virtualizing the mechanism of the exchanges. Trading venues should not allow hidden order types. Everything has to improve the transparency in the process. And various trading venues pricing models, especially the exchanges, they are going in terms of rebatings and volume based trading, and these kind of pricing mechanisms which the exchanges are offering, they are creating the deterioration of the market. So the typical thing that is expected is the rebate should typically go through a broker dealer only and it can't be a direct one. And from the regulatory perspective, the trading firms typically put this point across that the regulators are not able to understand the business properly. They can't use one size fits all kind of regulation for high speed proprietary trading mechanisms. And they should make the rules simple. Everyone should understand them. Today, they are not understanding the policies, practices, procedures that are anti-competitive. And it is very much expected that they need to go more and more on a consistent focus on the markets. The frictions that are arising between the different regulatory agencies is impacting the overall system. Some firms are acting irresponsibly with respect to risk management. So lots of regulatory improvements are very much required, and that is what is expected by this high-speed trading firms. Regulators are looking at problems and not the solutions. And more right now, it is seen that there are more trading venues, which is more exchanges are there than that are really required for a healthy market, because of heavy competition, even the unfair trade practices are coming into are coming into existence by the proprietary trading by the exchanges. So the market data technology challenges, they are becoming higher and higher for the trading firms. So they are becoming their profitabilities are typically at stake. But of course, because of this, retail investors are getting benefited because better prices are something that are coming into picture for them. So there are some positives, negatives, but at the end, it's the proprietary trading firms which have to play a very key role in terms of coming out with effective risk management practices so that this high-speed trading can flourish in the future. right?